Good morning, Internet. Happy Juneteenth, and welcome to Class 8 Personal Finance. Here's my disclaimer. I'm not a financial professional. I'm just a DIY investing enthusiast. So please do your own research, get educated, and make your own sound investing decisions. And this is a dangerous video for me to make. The reality is that pretty much no one has failed to retire, has had an investment plan completely fail because of the failure to tilt one's portfolio away from low-cost market cap weighted index funds. So if you stick with a three-fund portfolio, US stock market, international stock market, and bond market, it's probably going to be a sound strategy as long as you pick the percentages based upon your risk tolerance and your needs and you contribute enough, etc. But there are two main reasons to keep watching. One is an interest in using your investing capital more efficiently. So long as there's a reason to believe that you can capture a higher investment return by targeting more of the things that explain investment returns, you should at least be interested. And second, the three-fund portfolio is boring. And all the time, I see folks looking for more spice in their financial lives. And besides that, I drive an 18-wheeler through Chickasaw Nation in Oklahoma and get to see all the casinos. I see investors looking for the same type of lottery-like excitement in their investment portfolios, whether it be through cryptocurrency, meme stocks, or thematic ETFs. And as long as you're going to add complexity to your portfolio because you think it's fun, you might as well do something where the math actually says you're likely to do better. But what are factors or risk factors? Factors are sources of risk that explain the returns of investments. If you invest in market cap weighted index funds, you are already targeting one of them. It's called market beta, and we'll get to that. But there are others. And rather than just listing them outright right now, I like to show you where to find the most commonly known ones and why this adds a good deal of complexity that you actually might not desire. Let's go to the screen, and I'm going to go to VOO. Now, here's something close to what you might find in an employer-sponsored plan. This is an actual portfolio for VOO. It's Vanguard's S&P 500 ETF. If you're in the thrift savings plan, for example, you have the C fund. That's an S&P 500 index fund, so it's pretty much the same portfolio. Now, note the weight in the style box right here. I'm going to zoom in on this. I've talked about the style box before. Now, the y-axis is the easy part. This box up here is large companies. This row in the middle is mid-sized companies, and this row in the bottom is small-sized companies. Let me just click over to numerical weights, and it's probably easier to see on a screen. Now, the x-axis is the harder part. What are growth stocks versus what are value stocks? In some, value stocks are priced cheaper than growth stocks, but okay, what does that actually mean? It's not just the number on the screen when it says, oh, this stock costs $10 or something like that. So let's do this by comparing two stocks that you've actually heard of. We're going to compare two auto manufacturers. We're going to compare Ford and Tesla. That's not my ad, by the way. So let's go to Ford right here. The stock symbol is F. And I want you to pay attention to one particular measure right here. It's called the price to book ratio. Before I even go to that, let me also show you the style box right here under investment style, large value. So Ford belongs in that top left box that we saw under VOO. So Ford is in here somewhere. It's part of the 17%. Now, price to book ratio 1.00, which is pretty even number. But what does that even mean? This is the price of a share of a company versus how much that share is worth on paper in terms of assets minus liabilities. So let me explain that. With a price to book ratio of 1, you're getting what the accountants say the stock share is worth on paper. By paying $11.23 for a share of Ford stock, you are getting what the accountants say is worth $11.23 on paper. The ratio is 1. That might be not so surprising. Well, yeah, obviously, I want to get a good deal. I want to get what the stock is worth. Okay, but this is Ford, and Ford's just not that popular of a company unless you're a performance guy and you like Mustangs or something like that, or you hate Chevy, that kind of thing. But people don't brag about their Ford stock at parties. They brag about their Tesla stock. Yeah, Tesla. Now, the last time I looked up Tesla's price to book ratio, it was more like 32. Now it's more like 19.77 because they haven't done so hot this year. Still, 19.77 is a lot higher than 1. And note the investment style up here is large growth. So Tesla belongs somewhere within this 38%. And it's probably a pretty good chunk of this 38% because Tesla is among the top 10 stocks within the S&P 500 in terms of its value. Now, why is this 19.77? Because Tesla is new. Tesla is fresh. People are willing to pay $650.28 for a share of Tesla that the accountants say is almost 20 times less in value on the book in terms of assets minus liabilities. That's a really expensive price. In other words, you're paying 19.77 times more for this slice of Tesla, whatever percentage of the company it is. It's actually, it doesn't show us the number of shares outstanding here right away. Shares outstanding. So assuming that, so assuming all the shares are kind of worth the same, there's no share class issues. I think they're all the same share class. This $650.28 little slice is one, let's call it billionth. This $650.28 is 1 billionth of Tesla. And the accountants are telling us in terms of asset minus liabilities that 1 billionth of the company is not worth $650.28. It's worth 20 times less than that, however that math works. But people like Tesla, and Tesla has Elon Musk, and the CEO of Ford is, I don't know, neither do you. You don't know the name of the CEO of Ford. I happen to know the name of the CEO of GM, but not Ford. I actually don't know. And I'm not going to look it up. Now, let's talk about another number here. Here it is, beta. Tesla's beta is 2.12. Ford's beta, let's go to trading information, is 1.16. What's beta? Beta is the correlation of this stock compared to the overall market. So the market goes up by 1, Ford goes up by 1.16%. So if the market goes up by 1%, Ford generally has gone up by 1.16% over the last 5 years. Tesla, when the market has gone up by 1%, Tesla has gone up by 2.12% on average. Obviously, it's going to swing up and down. It's not going to be a perfect correlation. Now, what do you think the beta of the overall market is? Let's say in a fund like VOO, the S&P 500 ETF. What do you think the beta is on VOO? And now I am unpaused, and hopefully you all had some time to think. The beta on VOO is 1, which should not surprise you if you understand what's going on, because VOO, or the S&P 500, are generally measures of the overall market. It's not all of it, but they're basically basing this beta on the S&P 500. So by definition, that beta is going to be 1. The market goes up by 1. This fund goes up by 1. That's the whole concept. If it doesn't go up by 1 when the market goes up by 1, there might be something seriously wrong with its tracking error. So you go back to the style box here for VOO, and you can kind of understand what's going on with these two things. Oh boy, this thing's getting slow. So we talked about market beta, and market beta is the first factor that was discovered back in the 1960s. And what they basically found is that market beta explained much of the return of stocks, which makes sense because when you see the market go up, all the stocks go up. When you see the market go down, all the stocks go down. They tend to correlate with each other a lot. So our first factor is market beta, and it's been found to explain about 2/3 of stock returns. And once this idea was discovered, the idea became that if market beta explains 2/3 of stock returns, anything outside of that 2/3 was thought to be attributable to skill. But more innovations followed with what we just talked about. Size, so large, medium versus small. So size being that the small stocks tended to outperform the large stocks. And value, that the value stocks tended to outperform the growth stocks. So in other words, you're looking at this style box, and if you understand market beta and size and value, you're looking at an S&P 500 fund, and you're like, hey, I want some of this. I want more than 0 in my investments. Why does this only have 0? Well, because it's an S&P 500 fund. If I switch this over to, say, VTI, Total Stock Market Index, that's more stocks than the S&P 500. Vanguard's going for pretty much every stock that exists in the United States. And hopefully I can get it to load without having to pause you guys again. I'm going to try to be patient because I don't edit these videos. These are pretty much all live. Let's go to weight here. Under VTI, we've got 3% in small cap value. And by the way, VTI and VOO pretty much perform in parallel. This additional stuff down here hardly does anything. It's just not enough to move the needle. So suppose you're looking at your 401k funds. I'm going to go over to the list of funds in the thrift savings plan. For those who not familiar, this is the 401k type account for federal employees, including military. You've got the G fund, the F fund, the C fund, the S fund, and the I fund. And if you're familiar with these, you know that this C fund is an S&P 500 index fund. It's just like VOO, like we were seeing with Vanguard. And so you're kind of going, okay, I'm interested in targeting factors. What do I do with this? Well, here's small. Okay, small capitalization. So maybe I could overweight the S fund a little bit. But this one's not really that great because it's got a whole lot of mid cap. In addition to that small cap, it doesn't concentrate in the small cap like what you want. And it's not a value fund. It's blend. It's got value stocks, blend stocks, and growth stocks all in there. So you really can't target the factors with this one. Then you have the international index fund, which tracks basically large stocks in Europe, Australasia, and the Far East. You're totally missing Canada, by the way. That's another video that's been done. And so you really can't target these factors with these TSP funds. And then you're going to have to go, okay, hey, maybe I should do the mutual fund window. And I covered that in my previous video. The mutual fund window seems pretty complicated, and you have to have a pretty large balance in the TSP already to take good advantage of that. What about a typical 401k? Well, here's my 401k. By the way, I am not representing my employer or my union in this video. This is solely my opinion going on. And we're looking at these funds in the UPS Teamsters 401k, and it's pretty similar to the TSP. You've got a S&P 500 index fund. I like it when the names of the funds explain themselves. S&P 400 mid-cap index fund. Russell 2000, that's a small cap index. And it's not that great of a small cap index either because it's got a lot of growth companies. And a lot of these growth companies aren't even profitable, and they have lottery-like characteristics. So you know how I was saying, I'm trying to avoid lottery tickets and I'm trying to target things that have positive expected returns to improve my portfolio. The Russell 2000 isn't going to do that. So we don't have a solution in here either for trying to target these factors. Now, but hold on, because I just mentioned our fourth factor, and that is profitability. Let me go to the list. So now you're going to get the list. This is the FAMA French five-factor model, and it's named after the two guys who came up with it. And they originally came up with combining these three: market, beta, size, and value. And I included the more verbose names because you might see these floating out there. Sometimes in forums, you'll see them called SMB or HML. That's small minus big, high minus low. And I'm not going to get into the nitty-gritty of what those mean. Then you have profitability as a factor. So higher profitability companies with robust profitability tend to outperform those with weak profitability. Then you have investment. Companies that invest conservatively in new products tend to outperform those that invest aggressively to try to grow. So now we have this five-factor model, and it's named after Eugene Fama and Kenneth French. They identified the size and value factors in 1992. Profitability and investment came later to comprise a five-factor model. Now, there's another one out there that floats around called momentum, and that's not really part of the Fama French five-factor model. They say that it's hard to invest in, but I'll address that a little more later. You also might see quality in places. And in fact, if you go to Morningstar and you go to VTI here, they have their own factor profile right here. That's not showing up on the screen all that well. It usually looks a lot better than this. But you can see style, growth versus value, momentum, quality, volatility. They got some other factors going on here that I'm not going to address today, but quality is one that you'll see, and it's sort of a proxy for profitability. They're not quite the same thing. But let's go back to this TSP funds list here, just to review. So you want to target these five factors, and you're not going to get it in this small capitalization fund, this S fund, because it's just not small enough. And you're not going to get it in this Russell 2000 fund in my civilian employer 401k because it's plenty small, but he's got all these growth companies in there that aren't profitable. So it's kind of going against what we're trying to do. So enter factor tilting. And instead of doing that within a 401k or trying to get into a mutual fund window, and mine has a brokerage account within it that you can open, and that it just doesn't look like a really well-maintained website for doing that. But what you can do is use a Roth IRA or even a taxable account, but you probably want to use a Roth IRA for this one if you're normal. By combining plain, boring, but cheap market cap weighted index funds with concentrated holdings in these factors, you can target all five factors. If, for example, you have a 401k with market cap index funds, such as the ones I showed you, you can use the Roth IRA side to hold concentrated small cap value funds. And situations to that end will definitely vary. I happen to have 70% of my holdings in a Roth IRA, so I'm kind of weird like that. But for a lot of my peers, the employer plan is pretty much where they live in terms of their investments. They started off when they made full-time at my employer, and they started putting in 3%, they started putting in 5%, 7%, 10%, and they put it into a target date fund, or they just put into the S&P 500, and that's it. And then they open a brokerage account, and they go play. They go play with individual stocks. They go play with leveraged QQQ and cryptocurrency and all this other stuff. So why not use a Roth IRA for additional compensated risks instead of lottery tickets if you're going to do that kind of thing in the first place? And if you're not going to do that kind of thing in the first place and you just live in your 401k and deal with the boring index funds, hey, great. That's actually a good strategy. I'm not dinging that. So how would this look if you want to target factors and you've got to figure out the math? Again, this involves complexity and it's not going to be for everyone. Really, maybe 10% of investors should be doing this. So, hey, if you're still watching, thank you. I appreciate it. Let's go back to the screen. And let's go to, where's the spreadsheet? That's not the spreadsheet. Where's the spreadsheet? Oh, back here. I kind of revealed a surprise accidentally. That's okay. But we're going to go over, and by the way, this, if you're not familiar with my channel, this spreadsheet is going to be in the description. And so you can see all this historical stuff I've done, and I think it's pretty cool. Obviously, I'm biased. So here's what it might look like. This isn't a new 401k, by the way. I modified an old spreadsheet here. So let's say that this is your 401k, and your 401k contribution limit is $20,500 a year. And your Roth IRA contribution limit is $6,000 a year. And this assumes that you're not of that older age where the government will let you make catch-up contributions. So in a typical 3-fund portfolio, it might look like this if you have 10% bonds in your portfolio, but you could add, say, a U.S. small cap value fund and a foreign small cap value fund to work all this out. Now, if this is making your brain bleed, like you don't know how to figure out exactly how to do these percentages and all that, then again, maybe this isn't for you. So the way I did this is, and in fact, my current percentages aren't even my target percentages for some reason, but that's all right. What I basically did is a 60-40 ratio between US stocks and foreign stocks, and a 90-10 ratio between stocks and bonds, and about, I think I went for a, well, see, I allowed the Roth IRA contribution limit to drive the ratio between the normal market cap weighted index funds and the small cap value funds. You might want to target somewhere between a 20 and 30% tilt. Like 20 to 30% of the stocks you would want to have in small cap value. And yeah, I could, build a tool to put out the exact percentages, but I think that's something where you need to know how to do the math on that yourself, or maybe this is just going to be too complex. I fear that if I made this too easy and then you just kind of follow the spreadsheet blindly, that you're going to start getting lost, and I'm actually going to be doing people a disservice. So I'm actually not going to make that tool, in as much as I actually could make a spreadsheet to cause that to happen. So learn spreadsheets and learn the math if you're going to do this. And if you can't and you just want to live in market cap weighted index funds, go right ahead and ignore this. Let's talk about some of the options that you could use for US small cap value and foreign small cap value. And there's one fund's fact sheet that I did not pull up prior to starting the recording, so I'm just going to pull it up now. One of these funds is VIOV, which is Vanguard's S&P Small Cap 600 Value ETF. It's got a pretty cheap expense ratio. It's actually the cheapest expense ratio of the funds I'm going to highlight today. And note that it's a lot more expensive than your typical market cap weighted index fund. VOO, the S&P 500 index fund that we just talked about, 0.03. This is 0.15. And if I say basis points from here on in, I say, hey, an expense ratio is 15 basis points. A basis point is 0.01%. So actually, just recently, this came up in the news because the Fed increased their federal funds lending rate by 75 basis points. Oh my goodness, it's 0.75%. That's what that means. So this is 15 basis points, or BIPs, if you want to abbreviate it even more. Now, what's the gist with this fund? Well, remember what I said about the Russell 2000. I was over here and I said, hey, The Russell 2000, not a great index. Well, two things are going on here. One is that it's S&P small cap 600. And so S&P is a different index provider than Russell or FTSE Russell. And their small cap index actually has a screen for quality slash profitability. So there are, call it 1,400 companies that they decided not to stick in here that are small caps. And so this is a much better quality index, even though it has fewer companies. And then on top of that, they filtered them out for value, which is cheaper stocks. Remember, Ford versus Tesla. Ford is a value stock. Tesla is a growth stock. However, neither of them are small cap stocks. They're large. So you can go down here, and just to give you an idea of what kind of companies are in here, you have Helmerich and Payne, Patterson, UTI Energy, South Jersey Industries, probably a bunch of stuff you've never heard of. I've recognized a few of these. I recognize First Hawaiian, that's a bank. Bank United, that's here in my area. Helmerich and Payne, they're like construction equipment rental kind of thing, but they're not Apple, they're not Ford, they're not Tesla, etc. And also take a note at the price to book ratio, 1.5. So not quite as cheap as the Ford individual stock, but still down there in price to book compared to Tesla, which was at about 20. It was like 19.77. Note this investment style box, it's down in the small value area. So this is the kind of thing that we're trying to add to our overall style box. The other option you have here is IJS, which is the iShares version. And note, when you're buying an index fund, definitely note the index that it has, rather than going, hey, it's an index fund. It's fine, because index funds aren't built the same way. This is also based on the S&P Small Cap 600 index. So yeah, these are both index funds. And in fact, they're both market cap weighted. But when I say market cap weighted index funds, I'm really talking about like S&P 500, Vanguard Total Stock Market Index, C Fund, etc. So this index is different. It's targeting the S&P Small Cap 600, these small cap value stocks that we've been talking about. The iShares fund is a little more expensive, but hey, do your research, because either of these would do the trick. Unsurprised. Now, you can see Helmerich and Payne right here. I'll bet you that this is because this is as of June 17th, and the Vanguard one was probably as of the end of May. And obviously, individual stocks go up and down. But it's based on the same index, and so you'll get about the same performance out of these two. You stick one of these into your Roth IRA, you have your exposure to US small cap. Now, there's a little twist here, because these two funds were basically the way to do this until pretty recently, unless you had an advisor, because there's this one company called Dimensional Fund Advisors. And this company has basically pioneered the whole factor investing thing. They started in the 1980s and went on from there. And if you have a large screen or really, really good vision, you're going to notice a couple of names here. Eugene Fama, Kenneth French. Remember the Fama French 5-factor model? That is literally them. And they are members of the board of directors of Dimensional Fund Advisors. Now, why am I bringing this up? Because Dimensional Fund Advisors, up until extremely recently, like in the last 2 years, was only available to people who had financial advisors who participated with Dimensional. And the reason for that was because Dimensional wanted to minimize the amount of trading in their funds. They said, hey, let's work exclusively with advisors who share our philosophy, and the advisors will advise their clients and keep them from trading in and out and turning us into a speculation house. And it has worked. They have been a very stable company, and their clients have tended to be happy as long as the factors are working. More on that later. Now, here's the thing. Nowadays, we have ETFs. Dimensional didn't enter the ETF market until extremely late. So that's what I'm talking about when I say, hey, only until very recently that Dimensional has been available to us normies. But the first guys to actually make these more advanced factor funds available to us are these guys, Avantis investors. These guys started up, I think, in 2019. That's what I mean by recent. And so you've got these guys here. Let's learn about these guys. Eduardo Repeto, who is from Argentina. And note, prior to Avantis Investors established in 19, Eduardo was co-chief executive officer, co-chief investment officer, and director at Dimensional Fund Advisors. Okay. Pat Keating served as chief operating officer of Dimensional Fund Advisors. What is going on here? Mitchell Firestein. Senior portfolio member at Dimensional Fund Advisors. You get the idea. This is sort of a splinter group. Eduardo Repeto left Dimensional Fund Advisors, and what he said in podcasts is his wife lived in Los Angeles, and Dimensional is headquartered in Austin, Texas, and so he wanted to, stop commuting. That's his story. So it's not like he's putting out a story saying, "Oh, Dimensional's bad, and so I left, and I'm doing my own thing." Ah, ha, ha, ha. His story is more like he wanted to move back to Los Angeles, and then American Century, this company here, approached him and said, "Hey, how about you start up your own shop underneath our wing? We'll do all the paperwork for you and provide you with the office space, and you worry about the investments." Okay, cool. And so they started Avantis. And Avantis now has all these ETFs. They started up in 2019, and here you go. Avantis US Small Cap Value ETF. It started up in September 2019. And so now you have these more focused factor funds that aren't based on an index. They're technically actively managed, but they construct these funds really to focus on these factors. So here's where I start talking about the individual holdings that you might consider beyond those two S&P 600 value index funds that I was talking about. I'm also going to state very emphatically, I have substantial holdings in AVUV, so I am extremely biased. But I'm also going to show you the alternatives that I don't happen to have, but I still would be very comfortable holding. Now, AVUV is 25 basis points, which is higher than Vanguard's 15. So when you make a decision to go with this one, what you're basically saying is over time, I expect AVUV to outperform that Vanguard fund by at least 1/10 of 1%. And I actually do expect that because of their stronger focus on factors. And I always like looking at the top 10 holdings to see an idea of what you're getting. And you can see you don't have Helmerich Payne, at least within the top 10. I'm pretty sure you could find it if we were to click view all holdings, but I'm not going to go all the way that far. Now, Dimensional Fund Advisors had to respond. Now, some will say, hey, Dimensional was going to release ETFs anyway. They're not worried about Avantis because they're Dimensional and they're awesome. And okay, well, I mean, I do think they're awesome, but I think they had to respond. Note the inception date, February 23rd, 2022. They were later to the game. Again, Avantis was September 2019. So all the folks who were really excited about getting a small cap value ETF that was really, really factor focused started getting in, and Dimensional had to go, okay, we think it's time. They were resisting the ETF thing for a long time. And so when I started focusing on small value, it was like February 2021, I want to say. So I started going into small cap value prior to Dimensional making this response. So that's why I chose AVUV. I didn't have this one to choose, and I've chosen since not to switch over or to invest in both kind of thing. It's much less in net assets. The AVUV ETF is more like $3 billion. This is $258 million, which I believe could affect its liquidity. So it might be more expensive to actually trade on the market. And you'll also note the net expense ratio to the investor is 31 basis points. I wish this font were bigger. They're obviously capable of making bigger fonts because, I mean, look at that. And if I zoom in, I mean, it's just not that helpful, I don't think. But 31 basis points for dimensionals option. I still think it's a fine option, but it is more expensive. We'll talk about differences with more differences between Avantis and dimensional in a moment here. Now, those two are on the US side. On the international side, let's talk about two. Here is Avantis International Small Cap Value ETF. Because it's international, it's going to be more expensive. It's 36 basis points. So most index investors would really gawk at that and go, oh, absolutely not. That's absolutely disqualifying. And if that's how you feel, great. So 36 basis points. And let me bring you down to this. One of my sticking points is I avoid emerging markets unless I have some very specific intention. And nowadays, I only have South Korea as an emerging market. And a lot of folks would say South Korea isn't an emerging market anyway. But just so you know, if you're intent on avoiding China, Saudi Arabia, Russia, well, you can't do Russia anymore, but you get the idea. There's no China in this one. And then among the top 10 holdings, a bunch of stuff that I've never heard of, but you can look them up if you want. And that gives you an idea of how small these companies are going to be. And then on the dimensional side, you have DISV, Dimensional International Small Cap Value ETF. This was established in March 2022 and notes the Avantis Fund was started in, where is it? Also September 2019. So again, Dimensional came into the ETF game late. Now that said, they have been in the small cap value game longer, but while that was going on, these Avantis guys were working for Dimensional. So take that for what it's worth. This fund is also a lot more expensive. I don't know if I say a lot more expensive, but 0.42, 42 basis points. And it looks like there's some sort of waiver going on because it says the total operating expense ratio is 51, but they're charging you 42. Sometimes there's a waiver going on there because they want some room to bring the expense ratio up if they need to. But I've never seen a situation where they've actually brought it up like that because I think there's just a risk of making people angry and leaving. And you can see, I don't see a top 10 holding for this one. That's all right. It's probably in there some, oh, there it is. So there's your top 10 holdings. Again, companies that you never heard of, but you'll notice that the top 10 holdings aren't the same. These aren't index funds. They're employing factor strategies, but they don't always come up with the same answers. Now, why is that? Let's go to our factor list for a sec. The short answer to that is Avantis puts more emphasis on profitability. And if you dig through Avantis's website, you'll see a paper that they have that's reasonably easy to read. I at least found it, fascinating, and I've gone back to it. They put more emphasis on profitability than Dimensional. Dimensional really likes to put this emphasis on value, and in their small value, it's going to be primarily these two. Avantis tends to put more emphasis on profitability, and what that results in is when you look at the Morningstar style box, such as this one, I'm not going to pull it all up, you'll notice that the Avantis funds are more growthy on this side than the Dimensional funds. Dimensional funds are very heavy on the value. Avantis, still heavy on value, but not as much as Dimensional. Now, let's go ahead and close this out and do some main takeaways. So Avantis has that more emphasis on profitability. Their funds for small cap value are cheaper, as we saw, but Dimensional has been around longer. They have a bigger research team in as much as they've brought some people from Dimensional over to their side. And Dimensional has a more famous name and more famous names underlying it. They have the real Gene Fama and the real Kenneth French right there. But I still think Avantis can do a good job. The people who are there are competent. Main takeaways. You probably don't need this. Most investors will be just fine with plain vanilla, large market cap weighted index funds like S&P 500 and an international fund in a good ratio. But you may be able to handle the complexity of adding factors in there, and you might even avoid errors if factor investing keeps you from doing weird stuff like cryptocurrency and individual stocks and leveraged ETFs, things like that. Now, you also introduce tracking error because obviously these small cap value funds aren't going to do the same thing as your S&P 500 funds. If they did, then why would you even bother? But the idea is to target these factors so that ultimately, one, you want your final return to be more, but also there's an argument that it can help stabilize the portfolio as well because you have different risk factors coming into play at different periods of time. Now, that said, past performance is not a guarantee of future results. So you don't want to go like completely into small cap value necessarily unless you have very strong conviction that it's going to work. You don't want to have so much such that if small cap value just turns out not to be a thing, that you haven't caused your plan to fail either. So you kind of have to weigh those two things. And by the way, small cap value hasn't done that well in the last 10 years. The S&P 500 with all these tech stocks and the tech boom has outperformed the small cap value funds. So I have the fortunate happenstance, not skill, happenstance to have avoided small cap value up until 2021 because in all these years prior, from the time I started investing in 2008 up until 2021, small cap value underperformed normal market cap weighted index funds. And so I actually outperformed what I think is going to do better. If I had known all this stuff back in 2008 and I had started that way, I would have done worse. Kind of funny. And then also, this requires discipline. So imagine if this were you back in, it's actually 2009, not 2008, when I started using index funds. So imagine you had started with, a decent small cap value tilt in 2009, 2010, 11, 12, 13, 14, and you keep on going, and you see that the S&P 500 is just completely blowing away your small cap value, and you're like, well, I'm not doing this anymore. I'm switching over to the S&P 500. If you think you're going to do that, don't do this factor stuff because you have to be in it for the long haul. Let me take the opportunity to kill an investing myth because I just saw another video about the TSP. I'm not going to link to it. I'm not going to call out the names. I don't want to be mean on this channel. But he said, well, and I see this all the time on forums too, if the price of your fund goes down and you don't sell, you haven't lost any money. And I want to, slap the microphone or do something funny because it's YouTube and that's what you're supposed to do on the internet. I'm going to try to avoid that because my kids are asleep for one. No, that's a fallacy to say that you won't lose money until you sell. If you crash your Ferrari and someone tells you, hey, don't sell your crashed Ferrari, you'll lose money. No, you already lost the money when you crashed the Ferrari. Now, the difference with that analogy is you don't expect the value of the crashed Ferrari to go back up just kind of sitting there and steaming on a light pole or whatnot. But if your index fund goes down or your small cap value fund goes down, yes, you've lost money. You've lost the money. Now, what are you going to do about it? Are you going to hold and let it come back up, or are you just going to sell it and then lock in your loss? That's what I'm saying. So if it requires discipline and if there's a chance you're going to abandon the factor strategy, don't bother with it. There you go. My name's Garrett for Class 8 Personal Finance. If you liked this video, consider subscribing and leave a comment with any feedback you might have.